For the past decade, SCHD has provided investors with strong price performance and high dividend yields. In fact, since 2016, SCHD has outperformed peer funds like both VYM and SPYD by nearly 40%. Morningstar has consistently rated this ETF 5 stars over its lifetime. With an extremely competitive expense ratio of 0.06% and a diversified portfolio of over 100 dividend stocks, SCHD is one of the strongest options for investors who want a passive dividend portfolio. Currently yielding 3.73% in the form of quarterly dividend payments, it's no wonder why this is one of the largest and most popular dividend ETFs on the market. However, with changing micro and macroeconomic conditions, investors are starting to worry that SCHD may be running out of steam. In this video, we're breaking down 4 reasons why you should be cautious with SCHD, because it might be about to disappoint investors in the coming years. A questionable dividend yield. Over the last 12 months, this ETF has provided a distribution yield of 3.73%. Keep this number in mind as we'll revisit it in later points too. But first, it's important to consider this yield in regards to the makeup of SCHD's holdings. According to Charles Schwab, one parameter of SCHD's investment strategy is that an eligible stock must have sustained at least 10 consecutive years of dividend payments. This means that the strategy does not seek consistently growing dividend payments. To enter or remain in SCHD, a stock must simply have had at least an annual dividend payment over the last 10 years. Going deeper into the fund's methodology reveals that dividend growth is indeed one of 4 factors used to determine addition or continued inclusion in the fund. But it turns out that dividend growth is not quite as important to inclusion into this ETF as we would hope. Again, this means that SCHD is more focused on consecutive dividend payments, regardless of whether they grow or not. The reason for this lies in simple mathematics. SCHD considers a stock's 5-year dividend growth rate. The exact formula for this is shown on screen now. If the previous 5-year period has delivered high average dividend growth, then this formula will forgive 2 years of dividend stagnation and even a lower dividend payment. The problem with this is that some companies make marginal annual increases in an otherwise stagnant dividend, and others can continue inclusion in the index after a small dividend cut, which most dividend investors would be keen to avoid. In summary, the way dividend growth is accounted for means that SCHD does not seek consistently growing dividend payments as much as you might think. Specifically, investors need to be aware that a company can lower a dividend payment or allow the yield to stagnate for up to 2 years before it's removed from the SCHD portfolio. Interest rates and inflation. We're currently in times of micro and macroeconomic uncertainty. As a result, the Federal Reserve has provided indications of continued interest rate hikes. These interest rate hikes are considerably more likely than flat rates or rate cuts in the short term. Currently, the U.S. long-term interest rate is 3.49%, putting us at parity with levels we haven't seen since the early 2010s. Warren Buffett has summarized the impact of interest rates in our current situation, saying, "They are like gravity for valuations. If interest rates are nothing, values can be almost infinite. But if interest rates are extremely high, that's a huge gravitational pull on values." With Buffett's words in mind, let's dive deeper into how rising interest rates can raise some alarm bells for SCHD. First, take note that SCHD was incepted on October 20th, 2011. Considering the long-term interest rate chart, you should notice that SCHD was established in a very low interest rate environment. That low interest rate environment has prevailed since 2011, all the way until the Fed's quantitative easing policy ended just recently. This means that SCHD may be entering a world that it was not designed to thrive in. Remembering that SCHD only looks for consistent dividend payouts and effectively ignores dividend stagnation or cuts for up to 2 years, this means that SCHD will likely end up with a lot of stocks that are not ideal for a higher interest rate environment. And because there's up to a 2-year grace period under SCHD's parameters, SCHD could suffer in the short term before its portfolio is adjusted. But that's just interest rates. We also have to consider inflation. Year to date, 2022 has seen an 8.2% inflation rate, up further from 2021's 7%. The United States has not seen inflation above 7% for a sustained period since Jimmy Carter was president in the late 1970s. Now, recall that the distribution yield of SCHD is 3.73%. The dividend yield is lower than inflation by quite a large margin. In the context of being a dividend growth fund, high inflation rates effectively neutralize SCHD's value for new investors. On the bright side, the share price itself has only declined about 7% for the year, which compares favorably with broad indexes like the S&P 500 or the Nasdaq. But this combination means that SCHD's dividends fail to make up for inflation, and interest rates will suppress the value of stocks in the underlying portfolio. In other words, new investors are unlikely to see meaningful gains from either share price or dividend income in the near future. Geopolitical instability. It's worth stating that SCHD is extremely exposed to geopolitical headwinds. Most of the holdings in SCHD are in large US-based companies, which have international supply and distribution networks and sales channels. From an objective point of view, many parts of the world are in recession or on the brink of one. Continued sanctions against Russia and rising geopolitical tensions in Asia both paint a grim global financial outlook. It's important to consider these risks before allowing global exposure in your portfolio. But to be fair, this risk is quite difficult to escape anywhere else in the equity market, so we can't blame this too much on SCHD or its methodologies. Overall methodology. Unfortunately, there are some underlying methodologies with SCHD that could weaken the portfolio in the current environment. In addition to the 5-year dividend growth we highlighted earlier, SCHD uses 3 other factors for selecting stocks. One is free cash flow to total debt. Companies with zero total debt are ranked higher. 2 is return on equity. And 3 is expected forward yield, but Schwab provides no information about how this metric is calculated. You will notice that one key metric missing from SCHD is the PE ratio, or price to earnings ratio. SCHD does not take into account that a company may not be able to support a high current PE ratio. Another problem with SCHD's overall methodology can be understood by referencing the top 10 holdings. Each of the top 10 holdings are around 4%. The reason that none of their holdings reaches more than 5% is that SCHD's fund is capped by market weight. Many indexes use the market cap weighting strategy, where each stock in the portfolio is held in a weight proportional to the stock's market capitalization. Because SCHD largely focuses on large cap stocks, its largest holdings are often capped around 4%. As with any market cap weighted strategy, this means that larger companies will have the largest influence on SCHD's price performance. In some cases, this can actually introduce risk to the portfolio, as lower capitalization stocks that perform well cannot preserve the performance of the fund when large cap stocks do poorly. And because of the risks we mentioned previously, this environment is not looking great for some of SCHD's large cap holdings. The final aspect of SCHD that is worrisome comes from another parameter in their methodology. Stocks remain in the index as long as they are among the top 200 rankings. Yet, they must initially be ranked in the top 100 stocks to be included in the portfolio. This means they can drop as low as spot number 200 and remain included in the fund. This is similar to the dividend growth metric, where SCHD can be a little too forgiving with underperforming stocks. Ultimately, this means that stocks can perform quite badly over the short term before the SCHD methodologies forces a rebalancing and selects better stocks. Is SCHD worth the risk? For the most part, SCHD was a strong fund for investors to consider over the last decade. Up until recently, interest rates were low, inflation was at standard levels, and global economic activity was largely synchronous, all factors that helped SCHD to thrive. However, in the context of SCHD, the current environment has completely changed. The current environment could harm stocks in the SCHD ETF worse than others. And with its methodology and goals, SCHD does not seem to be well structured to adapt to underperforming stocks, at least during shorter time periods. For these reasons, it may be responsible to taper expectations for SCHD in the near future, or else you might be disappointed. Where are you investing for dividends right now? Let us know in the comments if SCHD continues to be a cornerstone of your portfolio, or whether you're looking elsewhere. For more, take a look at our previous video on some double-digit yielding ETFs, and stay tuned for the next video.